And we are live, broadcasting only on onedealaway.com/live. My name is Neva. This is Money Matters, and today is Friday, October 30th. So Halloween is tomorrow. Maybe I will have a costume. I don't know. I don't really do costumes, but maybe I'll do some makeup. I don't know. We'll see. I'll see if I can get creative for tomorrow. People are wanting Halloween and want to get scared, and I'm thinking to myself, did 2020 not scare you enough? Because it's scaring the daily bejesus out of me. And today's episode, I think, is going to be a very, very scary one at that. Because we're going to be looking at what's going on in the world of real estate, in the real estate market, and what you can expect to see. So, what am I seeing so far that I can summarize for you? Because some of you are on the run, you don't have time to watch the whole thing. Well, what I'm seeing is some concerning things. Of course, the big markets are very, very concerning. The small markets are starting to kind of get things concerning-ish. And of course, we are seeing start of a fall that I have been talking about in the September, and of course, I think October is going to be the same way, with the number of applications, number of purchasing, refinancing, and all of that stuff starting to go down. So we're going to take a look and explore what's going on in that neck of the woods. We're going to take a look at some of the larger operators of apartments and see where the rents are right now in our beautiful nation. And we're going to be looking at what's going on in the student housing sector, because I know many of you are invested in that as well, whether directly by being part of those companies that do student housing or through the REITs. So all of this stuff really, really matters, because one way or the other, there's a good chance that you are invested in the market and may or may not even know it. So let's do this. All right. Good morning and happy Friday to you. I do want to welcome everybody watching this live on onedealaway.com. Say hello. You got to sign in and then say hello. Signing in is, of course, free. And the cool part is you get a course for doing that. So, rewarding the good behavior. If you're watching this elsewhere, say YouTube or Facebook for that matter, or somewhere else, because I'm trying to expand my reach and branch out, so to speak, do me a huge favor. If there is such a thing as subscribe button, smash it right now. If there's notification button of some sort, smash it as well. And do me a huge favor as we go through today's episode. If you're finding things that you're enjoying, do me a huge favor and smash the like button. Now, the like button is not necessarily you agree or disagree what's in the news. It just means, is this worthwhile your time? And hopefully it is. My goal is to make it that your answer is yes, and that I get a super awesome thumbs up. All right. So what is going on in the world of real estate? Well, there's a lot of stuff going on in the world of real estate. And one of the things that we're going to take a look at is that pending home sales are falling. And of course, folks are starting to get concerned about this housing rebound, which I think it's rebounded plenty. It's actually rebounded a little bit too much for my flavor of the month. It's a little bit too sweet, as they call it. And whenever something is too sweet, well, it gives you a toothache. I don't want the toothache in real estate, but we'll see. We might see it. So what's going on? Well, pending home sales have dropped 2.2% in September compared to the previous month. And we've seen that we've sort of hit that kind of very much similar to the stocks. We've hit that sort of peak, and we're starting to turn the corner back on down. And that is what's going on. The Northeast was the only region that experienced a monthly increase, and Midwest was the largest decline in pending sales with a 3.2% decrease. Of course, many buyers started to struggle with the steeply rising prices and shrinking inventory, and affordability is starting and will continue to be a growing concern for Americans looking to buy a home in coming months. Housing rebound is stalling. That's basically what they are telling us right now. Now, when it comes to the prices, you might be thinking, okay, well, what is going on with the prices? Where are they going? You've seen yesterday we talked about interest rates and that kind of stuff, mortgage rates, which are connected to the interest rates, which are connected to the 10-year bond. So all of that stuff is connected. We're not seeing any movement in the interest rates or the bond as such. Even though people are like, it's dropping again, it's not really dropping. It is staying fairly steady-ish from what I could see yesterday, and you were able to see that on the show. But the home prices have been rising, and yesterday we have declared a clear winner in Phoenix, Arizona, and I explained yesterday to you as to why. If you have missed that episode, if you go to the YouTube channel, Money Matters, go over, click on the real estate, and you will be able to get that information. So, U.S. home prices rise at the fastest pace in 2 years. Case-Shiller 20 City Price Index posted a 5.2% year-over-year gain in August, up from revised 4.1. And I think we're going to see it probably at about 5.7 for September. I don't know. That's just my sort of guesstimates, but I could be wrong. Oh, look at this. Separate national index released with the report noted 5.7 increase in home prices across the U.S. over the past years. This is fastest pace in more than 2 years. And of course, let's see what's going on. Federal Housing Finance Agency House Price Index rose 1.5% in August and is up 8% year over year. That is the fastest annual gain since March 2006. Phoenix once again led all markets, followed by Seattle and San Diego. Now, this is kind of a scary piece for me because when we see it rise, I like it rising. I actually like the steady sort of 3.5 to about 4.5. But I like right around that 3.5 because that's sort of been proven to be a very healthy increase in the home prices. And the fact that Phoenix is leading again, because Phoenix led before and it also led downward as well, together with Southern California. But that's the sort of the red flag sort of concern piece that is happening. The fact that it's starting to mirror or sort of supersede of what's going on or what was happening in 2005 and 2006 is kind of on the I don't know what's going on kind of side. I know many people are excited about that stuff. For me, I want to see, sort of a prolonged piece. And with the slowdown, with the prices kind of going up, I am guessing that we might be sort of frothing up. Now, I am not seeing as much of a flipping activity happening. I mean, I'm sure it is happening. I'm just not seeing it as much. And that was the part that we've seen back before 2007, 8, 9, 10, 11 collapse kind of thing, right? So we're not seeing that quite yet, which is the good news, and I'm hoping not to see that as well. And it's one of those things that I definitely want to take a look into of what is going on in the area. Now, new home prices, of course, are still kind of holding steady-ish with the existing home market. However, I think that those are going to go through the roof, so to speak, and in the upcoming months. And when I say upcoming months, I don't mean like December. I mean more like maybe spring to summer of 21. And the reason for that is this puppy right over here. This is the lumber prices. This is where we were at the beginning of the year. This is where we were in August and September. And I have been reporting very actively on the lumber pricing and the fact that it is getting ridiculously high. Thankfully, we're starting to see a bit of a turn the corner, so to speak. And of course, the future price is dropping much higher or much lower. So there's a bigger gap between what the what the composite price is versus the future price. So I do expect that these prices are going to come down, which is hallelujah glory. Finally, this is what's happening. But in the meantime, there were homes that were being built that needed to buy up here. So the upcoming wave of the new homes, I predict that the prices are going to go up, and or if they not cannot sustain because market is turning the corner and prices are starting to drop, in that case scenario, a lot of the home builders will start finding themselves basically in the negative place, exactly where a lot of the large owners, the mall owners, that kind of stuff are also finding themselves, in a very much negative place. So I know a lot of people have been betting on the stock market, which we've seen actually decline quite a bit over the past 5 trading days. And so that's the concerning piece, that people have kind of jumped into the REITs, which I don't think. Um, Again, not a financial advice. It's just my thinking right over here. So if you need financial advice, find an advisor. Don't do what the random dude is telling you to do on a video. But what I think is, shorting it might make more sense, and you will see some of the new articles that we're going to be doing in this particular episode, where it's going to show you the case as to why. And again, we've talked about this about a week ago, 2 weeks ago. So again, you can jump onto the YouTube channel and go to the sort of the videos, go into the real estate version option, and you'll be able to see those videos where I share with you what, why, where, how, all of that stuff. So, and many people are, in the, wanting to get into the home builders because, they're seeing the boom and stuff. And home builders have been doing really well. But like I said, with the lumber prices going up through the roof, they're trying to keep their home prices, selling prices, kind of as down as possible in order to be able to sell it. They still have labor costs that they have to pay, which have come down since we last saw it, because people need jobs and they will accept lower pay in order to keep a job, as we discussed way back when, a few months ago. But I do think that there is a potential that home builders in the few months will actually start going down. So something for you to pay attention to and to consider if you are thinking about going into the home builders. And who knows, maybe shorting those puppies might make sense as well. But again, not a financial advice. Now, what is going on in the commercial real estate market? Well, CBRE, which I would say is one of the largest commercial real estate brokerage firms, is moving its headquarters from Los Angeles to Dallas. And there's a huge article that you can read, but basically they're able to say, millions of dollars. Actually, I would say they were talking about the fact that they can, save like tens, if not even hundreds of millions of dollars. And of course, the earnings per share reflected about 55 million from cost cutting. That is huge, and it follows the same tsunami wave, as I call it, of people exiting California, especially now with the newly proposed taxes. I was told they're looking to increase it over almost 17% for 21. And surely people will vote, and surely more people will leave, just because that's how it works. Now, speaking of tsunamis, let's go into the college market, college housing market. And of course, like I've said, you may not be necessarily directly invested into it or developer in it, although you might. I do know people who do that as well, but you might be invested in it through REITs or private holdings, or your as they call it, your retirement funds. That's the word I was looking for. So what is going on? Well, there is a problem because, as you know, the enrollment actually started to dip, because there's only so many 18-year-olds that we have right now. About 18 to 20 some years ago, we've seen that the number of babies being born is less. And what were colleges doing? Well, of course, we're growing more, 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 more. So they started to expand. Well, the babies were not born, and so now we're starting to see a shrink. And we've been seeing a shrink. I don't mean that kind of shrink, the deflation kind of shrink. Over the past, I would say, 4-ish years, 5-ish years, maybe a little bit more, depending from university, college to college, location to location, and what they offer. And of course, COVID is not helping at all, because many places have to go remote, want to go remote, the student wants to go remote. And if they go to remote, well, they don't want to live on campus. If they don't live on campus, there's no need for them to get into the student housing, nor to the housing that is surrounded by the colleges and universities. So we're seeing small mom and pop operations that are supporting around the colleges and universities, that off-campus apartment living that we all know that a lot of our students want to go in, as well as the large complexes that universities are owning or leasing. So what is happening? Well, the squeeze on university finance comes as the National Student Clearinghouse Research Center warned about 16% drop in first-year undergraduate students enrolled for the fall semester. This means new revenue streams are quickly drying up. Privatized student housing debt is paid off by the revenue generated by the dorms. Of course, that's just kind of how it works in real estate. Whatever you finance, right? It's basically the debt is being paid off by the housing. So they come in, they pay it, you take a portion of it, right? You pay off that mortgage. So same concept applies. It's just larger numbers. With occupancy rates already declining as coronavirus cases are surging, well, this could be bad news for colleges and universities heading into 2021. Privatized dorms are struggling the most given that they weren't structured to withstand 20 to 30% drop in occupancy. And that's a large problem that I have seen happening about for 2 to 4 years ago, something like that, where I started to look into it and I was considering getting into the market because everybody was getting into the market. I'm like, yeah, and I'm like, no, 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 no. You got to do the research, my friend. You got to do the research because when everybody starts jumping in, that's not when you want to do the same thing, right? That FOMO piece, you got to put it aside and say, nope, I'm too late to this game. I got to find a different game, a game that is coming after this one, and get myself there. And a lot of that can be done by research, by education, by following channels like Money Matters and engaging in it. And why not? It's absolutely free. And it's commercial free as well because it is sponsored by One Deal Away. And One Deal Away, we're basically a financial education company predominantly focusing on personal finance education. Real estate is our big thing, as well as crypto. So that's basically where we really focus on and what we work on. So in case you're interested, of course, you're welcome to come and visit. Would actually love, 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 love to have you. And, hopefully you will love the course. Everybody else that has been in it, we're getting some raving reviews, and I'm really excited about that. So what is going on? Well, when they built it, when I was looking at that stuff, when they were building it, they were building it at 95% occupancy, at 100% occupancy, at 120% occupancy, because they were going saying, well, no, 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 like you won't be profitable for the first 3 years, but in year 4, it's of course it's going to be profitable because you're going to grow. And people started to salivate, right, and would jump in. And I went and said, whoa, 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 time out. You should never price anything at 100% occupancy because that's unrealistic. If it happens, that's amazing, but it's not realistic. You should be pricing things at about 80% occupancy. And if you can be profitable at 75 to 80% occupancy, then everything above that is gravy and amazing. Remember, you want to protect the downside. Upside takes care of itself. And that is one of those ways to do it. And then the worst case scenario is saying, well, you're not going to be profitable right now, but in 3 to 5 years or 10 years or whatever, you will. Well, this is how people got themselves in trouble and how they get themselves in trouble all the time. If it doesn't make sense from day one, and then you don't go in. And as I wrote years and years and years ago, sort of like my methodology of investing, if it doesn't pay, don't play. And hopefully that helps you and motivates you to look into it and kind of have that motto as well to help you along with it. West Virginia State University faces considerable challenges in backstopping the bonds. Nearly 290-bed residence hall with rents of $3,881 per semester was just 71% occupied this fall, while it needed to be about 92% occupied to stay profitable. Ohio's Terra State Community College, which has more than 2,100 students, was downgraded deeper into junk over the risk posed by a dorm owned by a nonprofit. Occupancy fell 62%, and the college is using a previously received donation to cover a shortfall. New Jersey City University, a student housing project financed through a separate entity, will likely miss a required debt service. The student housing bonds aren't a debt of the university, so the school would be choosing to provide so the school would be choosing to provide financial support according to bond document. Student housing bonds issued by West Campus Housing LLC in 2015 were slashed deeper into junk in September by S&P. Occupancy there had fallen to 56%. Plunging enrollments resulting in falling occupancy rates for dorms is a debt bomb waiting to go off. And of course, I have been saying that for a very, very long time. Schools that I have been advising and consulting with, I have been advising to revise their plans, to revise their pricing structures. Of course, everybody's suffering right now because you have to reduce it even more than you thought you would before. But in a relatively speaking normalish years, many of these schools have been faltering and struggling. In my, prediction, well over 10 years ago now, has been that in the 20s and the 30s, we will actually see the number of colleges, universities that exist around the United States and potentially the world is actually going to start to falter, is going to start to fall. And lo and behold, here is what is coming from this article here as well. About 20% of college universities will shut down or merge in the next 10 years and probably more. Absent of a federal bailout, things could get ugly for colleges and universities in 2021. And I would argue the getting ugly without any federal support and stuff, it's not just for the college universities, but I would argue that goes for small businesses, medium sized businesses, large businesses, landlords of every size, and as well as the small sort of private human beings with or without a business. Because we are turning the corner, just not the corner that the incumbents for the upcoming election, which means Halloween is continuing well into November this year. Without their support and stuff, there's going to be some massive, massive, massive pain. I am personally, mentally, physically, emotionally preparing for that, not just for people, but for myself as well, to sort of say, okay, if this happens, what is my plan? How do I plan on dealing with it? And how do I reduce my stress? Because I went back and saying, what is the most important thing? And while we do talk about money on this particular show, I have come up with things that are the most important to me, and that is my own personal health, my sanity, my family, and everything else will figure it out, right? So I don't know what your mantra is, what you need to do, how you get yourself to it, where you draw the lines to say it's okay. But I do want to come out today and maybe put a little bit of the light in this very scary kind of show, because I still have more news to show you, and none of them are very positive. I apologize for that, but maybe this is the shiny light of the whole thing, that find things that are important to you that are not related to money and wealth. Your self-worth and your net worth do not correlate and should not be connected. They are separate things. Smart people make mistakes. Dumb people make mistakes, right? So your self-worth, your intelligence, your resilience, your ability to do stuff has nothing to do with your financial picture at all. To a degree, maybe, yes, potentially. But there are things that are playing around right now that are way bigger than you and I, way bigger than many of us, and even the people that actually control the flow of the money and everything else are also struggling, not knowing how to change things. I think they understand that the financial system that we all live in has died years and years ago. They've been trying to keep it alive, zombifying it, pumping it, out there with the heavy drugs and stuff, making it, try to move and behave like it's normal, but it's not really working. They know it. That's why they're talking about the new Bretton Woods. That's why they're talking about the CBDCs. That's why they're looking at the new innovative ways, because this thing is dying, and it's shifting everything that we know about it. And I don't know exactly what it's going to look like. I will keep up with it. I will keep on reporting on this show. So that's why it's incredibly important for you to subscribe right now. And if you have liked my message and kind of the direction of what we want to take, do me a huge favor, smash that like button right now, because um, as silly as it is, it really does help get this to more people out there, so that more people are starting to pay attention and learn, and can, prepare themselves, like I said, mentally, emotionally, physically, fiscally, and in any other way. So, rents are plunging. Rents are plunging in New York, San Francisco, Boston, LA, and some other expensive areas. And of course, we're going to take a look at all of the stuff. So, what is going on? This is the part that we knew was coming. We knew was coming. It's just, it was just sort of like maybe refusing to see it. But, this whole work from home, work from wherever you want, people are leaving. People are going into places. We all know that. It's, mass exodus. We've been covering it for months now. But they're going into less expensive, smaller towns, beautiful rural areas, safer, neighborhoods, more space to roam around. And as things are getting locked down again in Europe, and I think that that's coming to the United States as well. We are seeing basically people saying, no, 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 I really, 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 really need to get out of place, because I cannot be locked down. I need to go outside. I need to be able to go for a walk. I need a breath of fresh air. This tiny little apartment won't do for me. So they go out there, they get away, then they get stuck, and they're like, fall in love. What do they do? Well, they buy and rent places wherever they are, enroll their kids into the local schools, and basically say, this is it. This is it. Let's get internet, and we're working and living from here now. Now, of course, there are millions and millions of people that are doing that, and now we're seeing the prices starting to fall in some of the most expensive cities, and they have been falling for a while, but I don't think it's done quite yet. I could be wrong, but I don't think it's quite done yet. So San Francisco is leading the whole darn thing, and it's leading in the prices as well. So it would make sense that it would be the first domino to come down crashing. Median asking rent for one bedroom apartment in San Francisco fell by 1.1% in October from September to $2,800. I still think that that's very, very expensive for one bedroom apartment. I don't know. You let me know how you feel about the whole thing, but I think $2,800 for one bedroom, my gosh. I mean, come on. Bringing the plunge since April of $3,500 to $700, or 20%. So, of course, it's much better than $3,500, but I still think that this puppy has a room to go, and it would not surprise me if it falls down to about $1,700 or so. Which, if I am right, which I don't know that I am right, my crystal ball broke years ago, but if I am right, that's going to be well over 50% fall, and it could even get lower. It could even get to about $1,200, $1,300. So we'll see how it all goes. But that would be absolutely crazy. And if that was to happen, then we could see that many of the landlords in San Francisco and some of these large cities, large, very, very expensive cities, are going to basically just gift the properties away. And at that time, it might make sense to buy. Again, not a financial advice. I have no clue what's coming. I am guessing here, just using some of my experience, knowledge, to sort of guesstimate of where we might see things go. Two bedrooms apartment in San Francisco fell by 2.9% in October from September to $3,690, bringing the plunge since April of to $850, or 19%. So In April, it was 4,540. Now it's 3,690. And the reason that we're seeing slightly faster drop in one bedroom is just because people are tired of being kind of like, right? We've seen what has happened is an interesting piece. So people used to go from a 3 bedroom, 2 bedroom into 2 bedroom, 1 bedroom. They're trying to consolidate because of affordability. They're going in, they were choosing and voting with their money. That's how they were choosing, to go into smaller places. So it's less money to rent, it's less money to cool or heat, right? And so people were going with that. Now then Corona kind of came and everybody got locked down and you were like, oh my gosh, we're a family of three stuck in a studio. This is not working for me because I am here recording and doing my work. You are over there trying to do your work on Zoom, and then the kid is over there like practicing drum for their music session. I'm like, that is not going to work. So that's why we're seeing larger drop in a 1 bedroom versus 2 bedroom or 3 bedroom, but they're very very close. They're very very close. So this is kind of what's going on in the whole thing. And so here you can see it. Here's the August of 2019, right? So roughly a year ago, a little bit more than a year ago. And here is the October of 2020. And as you can see, from August 2019 to October 2020, we have dropped 24.5%. And you can see that in this chart right here. San Francisco remains the most expensive rental market in the US, although there are certain zip codes still in like Manhattan, LA, that are a bit higher than that. Speaking of New York, what's going on there? Well, 1 bedroom apartment, the median asking rent dropped 1.9% in October from September, from 2,800 to $2,800. So same as San Francisco. So San Francisco and New York prices are the same, and it's a drop of 15% year over year. 2 bedroom apartment, the median asking rent dropped 3% from October to September and 17.1% year over year. Very interesting. We're seeing the 2 bedroom actually drop a bit more, and again, I think a lot of it has to do with the price. Because people are still trying to basically figure out, can I stay in the city? Can I get some work over here? Because there's still jobs that exist within cities. Not everything can be remote. A lot of things that are, they are, right? But not everything is. And we're also seeing New York City. One of the things that to also note about New York City is that it is sort of financial capital, potentially of the world, but definitely of United States. And we're seeing many of these trading desks, many of the banks coming in and reporting and saying, things are not exactly the same with people working remotely. We need our traders to be at the desk, they need to be in the office. And so many of those services, those areas, folks are actually coming in. So you physically have to be there. New York city rent crunch. So from December of 2019 to October of 2020, as you can see, sorry, let me get this figured out. We are seeing a plunge of 17.2%. Now, here is the 17 most expensive U.S. rental markets. We've done this about a month ago. We're doing it again over here. You can see, of course, San Francisco is leading, and this is the 1 bedroom thing, dropping almost 21% from a year ago. And New York City is down 15% a year ago. Boston, Massachusetts down 12.6. San Jose, California 13.5. Oakland, California 19.2. Los Angeles 13% down. DC 14.8% down. San Diego, California 2.2% down. So far the least. Miami, Florida is actually up 2.3. Why? Because people are moving to Florida because of the taxes. Fort Lauderdale up 5%. Crazy. But you can also see, for example, Fort Lauderdale, the price for 1 bedroom is 1,680 versus San Francisco at 2,800, right? Plus, in San Francisco, you pay insane Cali taxes, which are about to go up almost 17%. And in Fort Lauderdale, well, there is no W2 taxes. So the income taxes on the earned income. Seattle, Washington is down 14.9%. Santa Ana is up 1.2%. Long Beach, California up 1.3%. Honolulu down 5.6%. Chicago up 3.4%. Philly down 0.7%. And Denver is down 12.5%. Now, of course, this is what's happening in a one bedroom. In the two bedroom market, we're seeing something fairly similar. And, oh, sorry about that. Let me see if I can get this done. So here we go. San Francisco is the price is $3,690. That's the median for two bedroom, and it's down 21% from 1 year ago. New York is down 17.1. LA down 14.7. Boston, Massachusetts down 8.5. San Jose, California down 9.2. Washington, D.C. down 8.5. Oakland, California down 12.3. San Diego, California is almost flat at negative zero point 0.4. Miami, Florida, Santa Ana are up. And Santa Ana, California is up almost 10%, 9.3%. Wow, that's definitely the highest one up. Fort Lauderdale down 1.4. Honolulu is flat at negative zero point 0.5. Seattle, Washington, negative 0.87. Sorry, negative 8.7, not 0.87, negative 8.7. Long Beach, California up 2%. Denver down 3.5%. Chicago is 1.1% up. And Philly is 4.2% up. So this is crazy. And of course, median, just so you know, is the half means half are higher and half are lower. And asking rent does not mean is the rent, because sometimes they ask for rent and then people negotiate. And so it could be that it's lower. I don't know that anybody negotiates like, no, 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 please, I know you said 5,000, but I'd like to pay 10,000. Hey, if you have a tenant like that, or if you are one like that, let me know. I might have a place for you. I just might have a place for you. And maybe there's a bridge somewhere too that I could sell you. Okay, Seattle rents. Here you go. This is what you can see. So from March 2020 is negative 14. LA from September 2019 negative 10. Denver from August 2019 negative 7. Boston from August 19 negative 17. DC from September 2019 12% down. Philly 5% down from July of 2019, so that's the least one. Houston down just 4% from August 2019, so not too shabby. Dallas also negative down from July 2019, negative down just 4%, so that's the least. Chicago from March of 2020 down 14%. St. Louis, well, they have not declined. They're actually kind of holding fat. Flat. Sorry, not fat. It's flat. Flat. There's an L in there, Nev. So St. Louis, Missouri, is flat. Let's see. National rent average dipped 2% since the peak in August of 2019, as you can see. So nationally, we're kind of down, but sort of flat-ish. And again, it all just depends from area to area of what is going on. And of course, now it's time to kind of close it up with the earnings for apartment owners, large apartment owners. So this was very helpful if you're considering of, where are you going to go, where are you going to move, do you live in these cities, do you go out there, do you change places, were you thinking of buying there, now you're thinking of not. I think that this particular research is very helpful to see if you're going to buy and hold, for example. Well, you want to take a look at where the rent's going so that you can price accordingly and negotiate accordingly. You should not be buying on the prices that were quoted a year ago. You should not even be buying on the prices that are happening right now. You need to really take a deep look into what's going on and where the puck is going, so to speak. To quote, is it Gretzky, right? Is that who it was? Anyways, earnings for apartment owners show the pain of urban flight. And yes, here we go again. Week quarterly earnings report from major apartment real estate investment trusts this week paint a bleak picture for some of the largest urban rental markets. Equitable Residential, whose portfolio consists mostly of mid to high rise buildings on East and West Coast, saw particularly bleak third quarter. Stock is down about 43% year to date. Ouch. Nearly a quarter of its holdings are in downtown San Francisco, Manhattan, Brooklyn, New York, which is funny. Downtown New York is Manhattan and Brooklyn, but never mind. Boston and Cambridge, Massachusetts, and those are the markets that are most impacted. Market conditions remain too volatile, and the timing of development on mitigating the virus too unclear to suggest that we have turned a corner. And I agree, there's still a lot of uncertainty to truly understand how low can this go and where it will go. Avalon Bay, which has a similar geographic mix to Equity Residential, also posted disappointing earnings, and the stock is down about 35% year to date. Now, of course, the proof is that the rents are down double digits, and individual that or large companies that are owning this stuff are offering things like 1 to 3 month free. Of course, they're offering like free parking, free this, free that, cover the electric, cover the heat. So they're doing everything and anything that they can. These are called concessions, in order to get people in to basically rent from them. Equity Residential noted clearly on the call that it's not losing tenants to competitors. They are relocating. They are relocating. They're leaving the area. So it's not like, oh, well, they don't like me, so they're going to go to George across the street. No, no, no. These people are packing and getting out the Dodge. Camden Property Trust, based in Houston, is seeing far better results and less impact from the pandemic. Its holdings are in Texas, Florida, Georgia, and North Carolina, and the stock is down just 16% to date. That's still a bigger drop, but you will notice that the difference and what is also matching with the previous report that we just looked at and talked about, that we're seeing these massive rent drops in these cities. But of course, Texas, of course, certain areas, is seeing a decreases, but not as steep, right? Like down 4% is very different than down 20%, right? Florida, we've actually seen some areas go up in rent, not down. Georgia, we haven't seen it, but my understanding is that they are like, again, it depends from city to city, place to place. Atlanta is, my understanding is some areas are up, some areas are down, some areas are flat. And we've seen some sort of suburbs of Atlanta that are actually way up. Like I feel like they're more expensive than New York right now. And of course, North Carolina has been a very hot state for people to move into for the past few years. So it makes sense of why the prices would kind of hold steady over there. Essex Property Trust, despite being largely in California and Seattle, has just 10% of its portfolio in urban cores. So this is key, and they're saying that limited 10% exposure to urban markets is proving its worth in that occupancy is flat year over year. So again, what are we seeing? Folks are getting out of that super high core urban areas. And this is the part that I think it's very important to highlight at this moment right now. And that is that it's very, very important, crucial, that when you are thinking about investing in real estate, that you don't focus on just one area and on that, because it's highly problematic. It's connected to the local economy, to the local taxes, to the local laws, to the local desires of the people, to potentially employment, maybe not, I just don't know, because that's all shifting and changing with more virtual employment and work that is happening. And of course, it depends on the type of property that you're getting, the type of tenant that you're looking to attract. And so I think it's very important that when you look at investing in real estate, that you have a diversified portfolio. So diversified portfolio could mean that they're in different locations throughout the nation, or even if you're sticking with only a handful of states and stuff, that maybe you have something urban, maybe you have something rural, like have a combination of things, right? Then you can have a combination of potentially single family homes versus multifamily versus rural versus urban, industrial versus residential. So you want to have a variety of things. You don't want to be like too crazy, because it gets a little bit challenging to manage. But again, if you get to the point where you're too crazy and you're just about every industry, every area, every place, chances are you probably are a very large company at that point, and hopefully, potentially, you have ability to also hire a lot of people that can help you with management, with operation, with guidance, with consulting, and all of that stuff. If you are interested in learning more about all of these things, you want to smash the button right now. It's that subscribe button, right? You can see it. Is it over there? Over there. I don't know. The camera and everything is, different. So you over there, the button, don't click it on the video, but click it. It's somewhere in here. Smash that subscribe button, notification button. Do me a huge favor. Smash that like button right now. And I will see you tomorrow for a Halloween show. We'll see what it's going to be. It's going to be trick or treat. I don't know. But we'll see tomorrow. Hey, thanks for watching. I super appreciate you. Go out there, have an awesome, awesome day. I'm going to go out and check out the first snow of the season. That's right. It's snowing where I am, and it's about to get super, super cold overnight. So it feels like winter all of a sudden. Until then, stay forever money blessed, and do remember, you are only one deal away.